In this recording, we're going to look at Summer 11 question 2, focused particularly on mergers and acquisition calculations, the valuation of synergies and the allocation of those synergies to the acquiring shareholders and the disposing shareholders. Note, this question is also available in your strategic finance and mergers and acquisition notes. So if you can't get the Summer 11 paper, it's available there as well. So this is an optional question this year for 22 marks, so about 44 minutes. Describe briefly two post-acquisition operational concerns, so 2 by 2 marks. Then the calculations is based on the expected post-tax synergy benefits, and for each of the 3 proposals, which you will see is 3 different consideration proposals, mix of equity, cash and debt. Estimate the post-acquisition total market value of the new entity, the combined entity, and then evaluate it from the perspectives of the disposing shareholders and the acquiring shareholders. Include financial and non-financial considerations. That's quite a typical one in terms of the big calculative area around mergers and acquisitions is value the synergies and figure out who obtains the synergies then, because either the selling shareholders get the synergies through the sales price, or the purchasing shareholders get the synergies through the use of the business or the running of the business post-acquisition. And then you're asked, based on the question facts, prioritise and explain 4 defence tactics the directors of Bayer could use to fend off the approach of Bull. So if the approach of Bull was what we call a hostile takeover, what are 4 defence tactics you can use? So again, you'd have been strategic in the exam. You could easily start with part A and C, get those out of the way for 8 marks, and then worry about the calculations in part B, because part A and C are not reliant on part B to do. So be strategic in terms of your sequencing as well as you go through. We'll just take them as they come. So I'm assuming you've read down through. You have Bull, which is on an acquisition strategy, and Bayer is the target. So we call Bull the acquirer, and Bayer is the target, smaller competitor. Again, in football, the primary motive here is the removal of any real competitive threat. But the directors of Bayer see this as hostile. They don't want to be taken over, and the 2 companies have very different cultures and operating styles. Right. Straight away, that's one that you're going to use for part A. Why am I told they're very different cultures and operating styles? Well, that's going to be a huge problem for post-acquisition. How are you going to merge these 2 together if they've completely different styles? So that's the first one that you're going to answer in part A, a very obvious one if you're reading the question. Bull are determined to proceed with the acquisition. Share price of Bull and Bayer 40 and 15 respectively, and the number of shares. So you have their standalone market values from here. We're going to use that as the starting point. There's 3 possible proposals for consideration: an all cash offer, an all share offer, and a cash plus share offer. And you should have a cheat sheet done out now around, well, what are the different pros and cons of cash or shares or combination, so you can refer to if you're doing an exam question like this. It's not that it's going to do the question for you, but it's kind of going to be a memory aid to help you along. Bull expects 40% of employees to be made redundant. Again, that is something else that you're going to put in as a post-acquisition operational concern. They should be jumping on it. If you're making 40%, 4 out of every 10 employees redundant, that's going to have huge motivational impact on your workforce. How are you going to manage your workforce post-acquisition? Who's going to be left? Who isn't going to be left? And you're going to have a very difficult culture to operate as well. So not only will you have to try and merge the 2 cultures together and the operating styles, but you're going to have a very hostile environment when that many people are made redundant. The employees own 30% of the company, and you're told the synergy benefits could either be 12 million, a quarter of a chance, 8 million, 50% chance, or 4 million, 25%. That gives you expected, when you do the weighted out, 8 million. So the 8 million isn't guaranteed, that's like the expected value. And the cost of capital is 16%. Bayer close to securing a 5-year contract worth 2 million, but they haven't disclosed this yet. And there's no white knights or squires on the horizon, and they don't want to use any of these damaging poison pills, shark repellent or golden parachutes. So what they're giving you in the last paragraph here is to say all of those possible defence tactics are not allowed. They're scoped out, so you wouldn't get any marks for those in part C. And we would have covered that in your strategic finance mergers and acquisitions lecture about the possible defence tactics. So we've done part A for 4 marks, quite easy. Different operating styles and culture is going to be a problem, and the amount of the employees being redundant is going to be a significant problem going forward as well. What we're now going to focus on, and the majority of this recording, will be on the calculation element of mergers and acquisitions. And that is, what is the expected synergies and what impact will each of the three consideration proposals have on each of the shareholders. So the value of the synergies here, you're going to value them as if they're a perpetuity. It's going to be 8 million per annum, and you have a discount rate, you're told, of 16%. So the present value there is the cash flow, 8 million, over 0.16. So the value of the synergies there are 50 million. Now that is one way to value your synergies, treat it as a perpetuity. The other way to value your synergies, you will see in a question called quality in the recordings. I think it was from 2014 past paper. That's where it combines company valuations and mergers and acquisitions. And you need to go back and look at that one as well for completeness. It will be in your list of key practice questions. So we need to figure out now, when this deal goes through, who gets it? Do the bull shareholders get this 50? Or do the bear shareholders get it? There's no mention of fees here, but usually as part of the transaction, some amount will be spent on transaction fees as well, but we don't have it here. So we have to figure out then, when we do the deal, and this will change depending on whether it's proposal 1, 2 or 3, we figure out who gets what. So we'll start off with proposal 1. And we want to know before and after. That's what we want to figure out. And we're looking at bull and we're looking at bear. So we're going to lay it out like this. This is the way you lay out all three. Figure out who's winning and who's losing. So it's repetitive once you do it once or twice, but it's important to be able to comment on it and analyse what it means as well. So if we take beforehand, bull and bear. Well, we know beforehand, bull had a €40 share price and 15 million shares. So 15 million times 40, 600 million. So we'll just put there euros millions. We also know beforehand the target had a €15 share price and 4 million shares. So they were worth 60. So beforehand, the bull shareholders had €600 million worth, bear had 60. This proposal 1, and I'll just bring this up one. This is what we call all cash. So here, what the plan is to offer bear shareholders 70 million cash. So afterwards, they're just going to have 70. So that means the gain here in euro millions, bear shareholders are going to be 10 million better off. Because they had something that was worth 60, they've been offered 70 for it, so they're 10 better off. But what about bull? Well, if we look at bull shareholders, and we put their working 1, just to show where it comes from. Well, the post-acquisition market value. What's the post-acquisition market value of this entity? Well, bull beforehand was worth 600. Bear beforehand was worth 60. They also get the synergies, because whoever owns the company will get the value of the synergies of 50. But they paid cash out of 70. So think about that now. I'll put that in a bit easier to see. So what you're saying is you acquired a subsidiary which is bringing you 60 value standalone and synergies of 50. So it's worth 110 overall and you paid 70 for it in cash. So the market value afterwards is 640 and that is 100% owned by the existing bull shareholders. The reason that is there's no dilution of control because they paid all cash. So that means here they are owned 640 afterwards, and that means they made a gain of 40. So what you can see here, the total gain made was 50. That's the value of the synergies. How it's been allocated out is the disposing shareholders got 20% of the synergies, the acquiring shareholders got 80%. And that's the kind of calculations that you're doing. You look at before the deal, after the deal, and see who's winning. In this case, the bull shareholders are getting a lot of the synergies. based on the deal that's done. However, other thing you're always looking at is who gets synergies is the first one. Is there any dilution of control? Right. There is no dilution of control here because they bought it all in cash. The acquiring shareholders still own 100% of the business. The other thing you're looking at is financing the money. In this case, bull shareholders, the company will have to get 70 million in cash somewhere. So they're going to have to finance that, and that might put a strain on their business. If they can, it'll avoid the need to dilute control, but sometimes a business cannot. And then the last one is the risk of synergies not being met. So who is taking on the risk here that these 50 synergies, remember these are just an expectation. If you come back and look here, they could be 12 million, it could be as low as 4 million. But the way the deal is done here, if the synergies don't come to fruition, the shareholders that are going to lose out are bull. Because bear shareholders have got a solid, guaranteed 70 million in cash, and they've walked away. They take no risk. So all the risk of the synergies not being realised, and that's a worry because of the redundancies, because of the different operating cultures, this transaction may not be as successful as they think. So the bear shareholders are taking a lot of that risk on. And that's what the examiner is looking for when they mean non-financial considerations is dilution of control. Can you raise the finance if it's all cash? Who takes the risk of the synergies being realised? All of those things are what you're looking at when you're making your commentary as well. Alright, so that's the first deal where you're looking at proposal 1, which is all cash. Then let's look at proposal 2, which is now all shares. So it's a different transaction. Proposal 2, all shares. And again, we're looking before and after. So before doesn't change, 600 million and 60 million. Let me just put there, working one is going to be both of them. After now, well, that's a bit trickier because what you're told in proposal 2 is it is a 1-for-2 share transaction. So for every 2 shares in the target, and they have 4 million shares, they get 1 share in bull. So you're working one here. 4 million shares in bear will equal 2 million new shares in bull. So bull post-acquisition will now have 15 million old shares plus 2 million new shares, which is 17 million. So what's happening here is bull doesn't have to spend any money. So they're not actually raising cash like the previous one. Instead, they have to dilute their control. So now they're dividing across 17 million shares instead of 15 million. So the old bull shareholders, they will now have 15 over 17 percentage ownership in the business. So they will own about 88.2%. The old bear shareholders, they will own 2 over 17, which here is 11.8%. So that's the 100% overall. So there is dilution of control. The acquiring shareholders now are giving up 11% of their business because they don't want to pay in cash. And if you don't want to pay in cash, you have to give something else. So they're giving shares instead. So about 11.8%. So how you figure out what's the value post-acquisition, you get the market value post-acquisition. And the market value will be bull standalone, which is 600. You bring in bear standalone, 60. And you bring in the synergies, which are 50. The cash paid by the acquiring company now is nil. So actually the market value post-acquisition is higher than previously was. It's now 710. But it's not correct to say bull now is worth 710 because this must be split 88-11. So that 710 is now split between, we call them the old bull shareholders and the old bear shareholders. So the old bull shareholders now, if you want to divide by 17 times 15 or multiply by 88%, you'll get the same answer, 626. So if you transparent out, 626.5. And then here, 710 divided by 17 multiplied by 2 million, because they now have 2 million new shares in the bigger entity. That's worth, if you want to bring it back, 83.5. So overall, it's the 710, but it's split based on their shareholding. So if you come back up here, you will say now this is worth 83.5. I'll just bring it to one decimal. And that's worth 626.5. So the gain here, 26.5, because it's 26.5 bigger than before, and the gain here, 23.5. But if you look, when you add them up, still 50. So you're still allocating out the portion. What's happening here now is there's a different gain on the synergies in each one. So this one captured more than half. It captured 53%. This synergy here, that captured 47%. So it's nearly an even split of the synergies overall. So think about how this differs now. Number one, Bull does not have to raise finance, because all it's doing is giving new shares out. There's no cash flow impact. So there's less stress there on raising the finance. Bear now is getting more value. Before it was only getting 70 million in cash, it's now getting 83 million in shares. But the big tricky here is that's not guaranteed. That if the synergies are not as successful as you thought, both shareholding groups will get hit. There's no guaranteed amount of money here, whereas the 70 million up here for cash was guaranteed. So the synergies, Bear is better off, it's getting more of them, but it's taking on more risk because that 83 is not guaranteed. And also another important thing for Bear is it's still involved in the entity post-acquisition. So if you have shareholders who want to continue to be involved, this all shares make sense. Whereas up here, the 70, it doesn't make sense because they're now finished with it. And the last thing to consider here is your tax liability. If you take cash, the shareholders of Bear will have a tax liability straight away. It's what we call they will crystallize a tax liability. Whereas when you come to here an all share offer, you defer your tax liability. You would probably cover this in Cap 2 tax because you're doing a share for share exchange. So the tax liability will only be crystallized or incurred when you actually sell on those new shares sometime in the future. So there is a tax element to it, there's a control element to it, there's the synergies, and there's the financing. So there's a lot of work involved there from a non-financial perspective to analyse it. But we'll put them all on the table at the end just to see exactly which one is better for which group of shareholders. So your last proposal then is a combination of the previous two. So see, can you pause this now and bring it all together for proposal 3, which is cash and shares. So it's a mix of both. So see, can you have a look at that and work your way through it. So pause it there and we'll come back and look at it. So looking at the last proposal then, if we bring it up, this is 25 million cash, so lower cash than all cash, and a 1-for-4 share issue. So the before stays the same, 660. But if we look at now, they're going to get cash, so don't forget, we'll put in the cash there so we won't forget it, 25 plus. We have to figure out what shareholding will they get as well. So we're going to look at here now, there's going to be the 4 million shares in Bear is going to be equal to 1 million shares, 1 million new shares in Bull. So you're going to get less shares than before in working one. The reason being now, because you're getting cash as well. So you're only doing a 1-for-4 swap instead of 1-for-2. So that means in the new entity, in new combined entity, you will have 15 million old Bull shares and 1 million new Bull shares. So the old shareholders are going to own 15/16, and the new Bear shareholders are going to own 1/16. So put those in percentages just to show the shareholding. So there is a dilution of control, but it's less than before. So you're diluting control now to about 6.3%, whereas before you were diluting control to about up here 11%. So it's less dilution because you are paying some cash. So what's the market value then post acquisition? Well, let's bring down the same working as we did before. Come down here and you're looking at the market value post acquisition. It's still 600, still 60, still 50, but be careful, you have now minus 25 because the acquiring shareholder has to pay 25 million part in cash. That's part of the transaction. So the overall market value of this bull post acquisition is 685 million. The old bull shareholders are going to get 15 over 16, or the 93%. So they're going to get about 642.2. The old bear shareholders, as well as the cash that they're getting, because that's where they're getting that 25 million, they're getting 1 over 16, or the 6.3%. So they're going to get 42.8. So that's going to be their values post-acquisition in terms of shareholding. So it's very repetitive in the three alternatives. So if you bring those back up, this is going to be worth 642.8, or 642.2, sorry. So they made a gain of 42.2. Here, be careful, it's 25 million in cash, plus you're going to have shares worth 42.8. So you have to put both of them in, and that means they've made a gain of 7.8. So again, your sense check is the overall gains come to 50, because that's where the value has been created. But we see the big winner here is the bull shareholders. They're capturing 84% of the gain, whereas here, the bear shareholders, they're only capturing 15%. So really the bear is losing a lot of value here. It doesn't really look to be a runner. They're much better off either taking the all shares, if they want to have the shares, or they're taking the cash if they want to remove the risk and be done with the business overall. So we'll put these all side by side in a second now to finish it off. But the first thing is to know how to allocate the synergies. And that's an important part of negotiation when you're dealing with M&A. So if we come down then and we look at proposal 1, 2 and 3, and we look at all bull shareholders and bear shareholders, and we say here P1, P2 and P3. So P1, the value here, if you go back up, is 640 and 70. 640 and 70. In P2, you're looking at 626.5 and 83.5. So let's put those to one decimal to make it neat. And then you're looking at 642.2 and 67.8. 67.8. So we're just trying to put these side by side to look at. In this case, they get 11.8% of the shareholding. So just put that beside it, 11.8%. And in this case, they get 6.3%. Just to remind you, they're getting, as well as they're getting value, they're also remaining involved in the business overall. So just trying to put these side by side. So this is where you're going to make your comments at the end to see which one will be better off or who's gaining, who's losing. So 11.8% proposal 2, 6.3% in proposal 3. So if you're commenting here and you want to have a look through it, well, it depends. For example, if we take bull shareholders, because if you look at both, in bull shareholders, the best one financially is proposal 3, where you do a mix of cash and shares. But that still means dilution of control. So if your bull shareholders want no dilution of control, for just a small bit less, you're better off doing proposal 1. You're better off buying them out in cash if you can finance that cash, that 70 million somewhere, and getting rid of the shareholders. So you have no dilution of control, but still capturing most of the value of the synergies. So for bull, probably the cleanest one would be proposal 1, where you have no dilution of control and you're still getting very close to maximum value. For bear shareholders, you're probably looking at a choice between proposal 2 or proposal 1. If you want to be involved in the business post-acquisition, i.e. you want to still have a shareholding, and you're not too worried about, for example, taking cash, then you look at proposal 2. Because proposal 2, you get no cash, you just get shares. You're still involved in the entity post-acquisition, the 11.8%. Right? But remember now, you're taking a risk there that the synergies will not be realized. So if you don't want to take that risk and you say, look, I just want cash, I don't want to be involved in the business anymore, well then proposal 1 would suit you. So you can see if you're going for proposal 2, that's the least one attractive to Bull. So you see there's going to be negotiation between the two shareholding groups. But what you're thinking about is, you're thinking about, do I want to take risk of synergies? Do I want cash? Do I want to take cash off the table? Do I want a tax liability? Because if you take cash off the table, you have to take cash, you have to have a tax liability. Do I want to continue to be involved in business? So for example, if you want cash and you also want to continue to be involved in the business, maybe proposal 3 will suit you because you get the best of both worlds. But remember, that's the lowest value of the synergies. You're only getting 7.8 million of the synergies compared to 40 million for Bull. So you may have to go back and renegotiate the terms of that. So it's not as if there's one perfect silver bullet of an answer here. What we want you to think about is, do the financials out, who's gaining what in each scenario, but also think of the non-financials. The synergies involve dilution of control, the tax liabilities, the ability to raise the finance if you're doing an all-cash deal. And that's what we're talking about in mergers and acquisitions calculations. There's a good example covered in the textbook, Pike and Minnow, and there's another exam question called Quality as well, all of which cover similar type calculations. Your last requirement then, which probably should have been done before the calculations to get marks on the board, 4 marks, briefly discuss 4 defense tactics that the target directors could use to fend off. And what you're looking at here is, you should be looking at your mergers and acquisitions notes, because this is covered in detail here. What are the types of defense tactics? Well, number 1 is you lobby the regulator to say this is not a good move for consumers because you're removing the only real competitive threat. So on competition grounds, this is not a good takeover. And you'll see that any time any 2 big competitors come together, whether it's supermarkets, bookmakers, you have to get competition clearance. And the competition authorities will not give you clearance if it removes competition and is bad for shareholders. The second thing you'll do is you'll lobby the employees. Because remember, employees own 30% of the company. And you will tell them, why would you vote for something that's going to result in a lot of you losing your jobs? So lobby them and say, this is not good for shareholders. It's not going to result in the best outcome. You can also tell them that you have a lucrative contract and you'll say that this is going to be worth 2 million. It makes sense to stay with us. It doesn't make sense to sell the company on to shareholders of Bull, where you might lose your job and you may not have this contract. So number 1, you look to lobby the regulator to say this is not good for competition. Number 2, you lobby the employees. That's why you're told the employees own 30%. Number 3, you inform your shareholders that you have a valuable contract coming down the line and it makes sense not to sell the company, to stay because it's going to generate a lot of value. And the other thing you could do, which is often recommended as well, is you be more proactive with your shareholders. So the directors of Bayer, the target, should be more proactive and say, this is what we're going to do next year. This is the value we can create for you. And again, the shareholders then can compare that value to the transaction. So they say, does it make more financial sense to stay with the current business, to run it ourselves, and what value is it going to generate compared to if we sell it on? So be more proactive communicators, lobby the takeover panel, or lobby the regulator for competition grounds, lobby the employees about their social awareness and the fact that there's going to be a lot of redundancies. This will not be good for them. And again, disclose the valuable contract that will come down the line if this company is not taken over. So it's 4 points, 1 mark each. But I said, be strategic. You could have done part A and part C, got 8 marks on the board, and then given plenty of time for your computational piece, part B at the end. So that was looking at mergers and acquisitions, a key area in strategic finance. And it's important to go back and look at that session now to look at other examples, particularly from a computational point of view.